So how the heck did we go from the market going through a pretty major correction in April till late July and the market's hitting all-time highs once again? It's a great question, and I haven't done a video like this, but I'm going to talk about an article in the Wall Street Journal that just came out, and it's titled "Economy Shows Swagger as Tariff Fears Ebb." And the subtitle here is Consumers Resume Spending, Helping to Fight Off Worst Case Scenarios of Impact. And that's what I want to talk about is so much of the United States economy is based on us as consumers. The US consumer represents almost 70% of the economy in the United States. So oftentimes what causes a recession is it's this downward spiral. We get scary headlines, people get cautious, they start cutting back on their spending, and that becomes a self-fulfilling prophecy. Now, what's interesting in this case, because the challenge that many of us were worried about is what kind of headwinds are these tariffs going to cause? And this is not a political channel. And one thing I will say is while a lot of very smart people are saying, well, of course, the tariffs are going to be a headwind. That's what the PhDs, the Nobel laureates are all saying is this is a bad thing for the United States and it's a bad thing for the world. But you can see how even though sometimes the news is bad, we don't get that negative impact that everybody thinks is going to happen. So are we going to get that negative impact? And if we do, when will we get it? And the reality is, I don't know. And nobody knows. And even the smartest people in the room don't know because there's so many factors. But one of the things I do know is if you get the consumer right, if you can think through what's the consumer likely going to do, if you get the consumer right, you're going to increase the likelihood of figuring out how the market is eventually going to react to it, or at least how revenues are going to do for companies and things like that. So why has the stock market recovered so strongly? And I think it's a surprise to many. I mean, I'll be candid, it is a surprise to me that the market is doing as well as it is. And the issue is the economy, particularly the world economy, is incredibly complex. So I'll share something about headwinds and tailwinds, and then I'll share what does it mean to you and I, and what do we do? So I think the tariffs are going to be a headwind. How big of a headwind? I don't know. But we have 80 years that it took to put these trade partnerships in place, and we're going to be rearranging those partnerships in a fairly short order. And just like we saw with the supply constraints as the pandemic began to wind down and the supply chain challenges, I think we could see something similar where there's some unexpected consequences. Again, I don't know. I hope I'm wrong. I hope it's not that big of a headwind. But a tailwind that I think companies are going to benefit from, and I'm a little concerned about this. I've got two adult daughters that are just launching their career. And that is, what's the impact of artificial intelligence, AI, going to be? And here's my take on that. And then I'll share what do we do based on, maybe a headwind here and a tailwind there. And so how do you navigate that? But my thoughts on AI is just like when the computer came out, just like when the internet, began to become popular. These are things that allowed people to do more, allowed employees to do more, allowed companies to do things better, faster, and cheaper. And it increased our productivity, and hopefully we gained from those productivity gains. Unfortunately, the data shows that many of us did not. But hopefully we can figure out a way how everyday average people like you and I can benefit from our increased productivity. So I do think AI is a step change technology that's going to allow companies to do things better, faster, cheaper. What I don't know is which industry it's going to impact. How do I give advice to my daughters on that. And as I record this, I just retired a little over a year ago. And the changes in my industry, I was a financial advisor before I retired. The changes in my industry just in 12, 13 months is dramatic. So and it allows financial advisors to do more of the work that moves the needle for our clients and takes away some of the routine work that we used to have to do. So I think that's a good thing. And there's a shortage of good financial advisors. So allowing good financial advisors to do more work is a great thing. Quick aside, what do I consider to be a good financial excuse me, a good financial advisor is somebody that's a fiduciary to you, puts your interests in front of their own, and has been doing it for at least 10 years. I know that makes it harder for people that are entering the industry, but you get a lot of wisdom. There's the academic numbers, but then you get a lot of wisdom from time in the seat and from time helping families and seeing when families succeed and seeing when families do things that maybe you advise them not to and see what the impact of that is. Sometimes it matters, sometimes it doesn't. But what does all of this mean for you and I? What what it means for you and I, going back to this article that, the economy is showing swagger, that's a good thing. Sorry, excuse me. That's a good thing, and that's one of the reasons that we're seeing the stock market do well, but it just shows how hard it is to time things. There's always a reason to worry about the stock market. Um, there's always there's people that I call perma bears. They're either worried about the next bear market or we're currently in a bear market and they're worried about the depth of the bear market. They keep thinking it's gonna go lower, and you don't wanna be that person, you also don't want to be naively optimistic. I think it does pay to be an optimist, with to be an investor, but I think you wanna be a cautious optimist. So how do we succeed? We succeed by having a long-term asset allocation and we have that asset allocation. We come up with it for both good times and bad times. So in April, when the market looked scary, I think top to bottom, and the S&P 500 was down over 20%. That's a big move. Um, and you have an asset allocation that you can stick with in bad times, and then also you can stick with it in good times. And you might say, "Hey, Azul, why would anybody blow out in good times?" But remember, for most of us, we're going to have a combination. And I should say this is not financial advice. I don't know your situation, but many of us are going to have a combination of both stocks and bonds. And when times are good, it can be easy to think, well, if I didn't have these lousy bonds, I would have done well, and so people end up getting aggressive, increasing their allocation in stocks at just the wrong time. So our asset allocation, I believe, is gonna be the primary driver as a success as investors, and the way to get that right, I think the gold standard is to work with a financial advisor. You can hire them on a project basis to help you come up with that asset allocation. I think it's best to have a relationship with that financial advisor, and I know many of you are not going to you don't want to work with a financial advisor, you wanna do it yourself. And if that's you, I urge you to not use Google Sheets, to not use Excel, but to use software that's easy to use, that's more robust, that makes it easier for you to succeed. The softwares that's designed for people like you and I, it's very affordable. The software that I like is called Bolden. It used to be called New Retirement. There's a link in the description. If you use that link, you'll be supporting the channel. I am an affiliate. And if you enjoyed this video, the next video of mine that I think you should think about watching is this video here, where I talk about why waiting to 65 to retire might be a big mistake. Thanks for watching this video. Bye-bye.